I would never advise you guys to buy something, no disrespect, Graham, at a 15% discount. The split, the numbers just aren't there. Hello everybody, how are you guys today? Joe Perez, Flipping Unleashed, and today we're going to do a video. I've got a YouTuber, his name is Graham Stephan. Maybe you guys have or haven't heard of him. Evidently he's doing something right. He's got almost 1.1 million subscribers, and he's also done a lot of work in real estate and other things in finance. So today we're going to watch one of his videos. I have not watched this video before, and I'm going to give you an honest accounting and analysis of what I think, what he's advocating, what he's espousing, what he believes in, okay? So stay tuned, and at minimum, you get to hear a unique third-party opinion from a guy who's been doing this his whole life and done very well at what he does, okay? So this video is my millionaire real estate investing strategy. Not sure what the name entails. I would think millionaire probably means that you're worth at least $1 million. So let's see. Let's start from the beginning. Here we go.
What's up, you guys? It's Graham here. So about 2 weeks ago, I made a video explaining why I now own a little bit over $4 million worth of real estate and why I choose to pretty much invest everything I make back into buying more property. Which, if you're wondering why, because you haven't watched that video yet, then shame on you. Go and watch that video and hit the like button for the YouTube algorithm, of course, but I will summarize that video in just like 20 seconds. Here you go. First, I could borrow a lot of cheap money by taking out a fixed 30-year loan at an interest rate that's just barely above inflation. Secondly, I could leverage my money to get an even higher return on my investment. Third, real estate just tends to make for some really good cash flow. Fourth, I can get a lot of great tax advantages. And number 5, I'm a believer of long-term appreciation of property values. So given all of that, it's pretty much been an unspoken goal of mine to try to buy a new property every single year, whether it be for myself or for an investment.
So he just mentions right now all the benefits of his strategy and investing in real estate and the tax advantages and borrowing cheap money and things like that, which I agree with. I love real estate. Right now he's getting ready to mention, it looks like, how he has a strategy where he likes to buy one home a year, you know. There's no doubt that I have many more years in this industry than Graham does, just purely by the age and what I do. I can tell you that my style is probably a little bit more aggressive. Like he talks about borrowing cheap money. To me, I don't care to a certain degree. I want to borrow money at the cheapest point that I can, especially when you're getting started, but it doesn't mean that it has to be cheap, right? It just means that the money you borrow, you have to make sure to translate that money into something that will give you such a great payout that the cost of the money, whether it be a high interest rate or you had to pay fees and points or whatever, justify it because you're making an incredible profit. He's talking about buying one home a year now, so let's see what his strategy for that.
And this year is absolutely no exception. I have been grinding away every single day over the last year, pretty much saving 100% of my income in preparation to buy something new this year.
So he just says he's saving 100% of his income to buy something new this year, okay? Which is great. I'm glad he's motivated. I'm glad he's directed, but I can tell you it's a little bit different about how I feel about things. See, investing in real estate, deals are vehicles, right? And each deal, each vehicle can produce profit for you. So to me, I like to have a lot of deals in the work. I like to have multiple vehicles working at once. So do I want to keep saving my money for one deal and buy one deal? Probably not. My style is a little bit different. Like I said, I'm a little more aggressive. I love real estate and I have a pretty good sized portfolio, definitely over the tens and tens of millions of dollars, okay? Which, don't get me wrong, that's really good, but you know, in Southern California, property values are expensive, so we're always gonna be in the high millions over here. But anyways, my point is, I'd rather do a lot of deals. And I don't wanna spend all my resources on one deal. If anything, my attitude is I'm always flipping stuff. Then I find those right deals. You know, there's a loan I can take over, it's called subject to financing. I like the neighborhood, it's a great rental neighborhood, whatever, and I'll keep the deal. But the point is that because I'm more liberal on how I get my money and other strategies, I can buy more property. And in this game, you can do like what Graham mentions, you can get one deal a year, and that's a solid, stable plan for him. Or you can hear my point of view, which is a little bit more aggressive, right? Which will yield you quicker results. And that is if you try to invest a lot more and consistently invest and keep turning your money, keep turning your money, keep turning your money. So by the end of the year, you're in a situation that you can own multiple rentals you acquired that year and have multiple streams of income and turned over a lot of deals during that year, okay? But let's keep hearing them out.
For those who aren't aware, I've been working full-time as a real estate agent here in Los Angeles since 2008. I've been buying and investing in properties since 2011, and the real estate market is something that I've spent hours looking at every single day for now over a decade. I see pretty much every property that comes on the market. I see exactly what sellers are expecting to get. I see what buyers are willing to pay, and I see where demand is growing and which areas are poised to rise in value. And I feel that submersing myself this much in the real estate market gives me a huge advantage in terms of making money over many of the other people out there, because I get to see all of this happening firsthand in real time.
You know, he's right. He's a realtor, and he's on the multiple listing service. So every day, as part of his real estate functions, he is seeing listings, he's seeing what's available, how fast things are selling for. So he has a great idea of what real estate trends are, what neighborhoods are hot and so forth. And he definitely has that advantage because he works in the industry. But also understand that if you don't work in the industry, that's okay, because there's realtors out there who do work in the industry that you can hire to, and when they say hire them, you don't got to pay them out of your pocket, but you can work with them and say, hey, I'm an investor, or even just not even an investor, just a guy who wants to buy a few rentals or whatever, and let them go out and find deals for you. And by the way, the multiple listing service is one of many sources to find deals. It's a convenient source because it's like the major marketplace where people are listing their homes, but it doesn't mean we can't discount the value of other things like foreclosures. Some of the best deals I've gotten is properties going to foreclosures, tax sales, probate, things like that. Things that aren't necessarily on a traditional MLS are very powerful sources of finding great deals. Matter of fact, I would argue those are your best sources because those sources, they're less competitive and sometimes not everybody knows about them. Whereas on the MLS, it's out there for the public. It's posted for the whole world to see.
And for that reason, I have absolutely noticed a shift in the real estate market this year. At least here in Los Angeles, the luxury real estate priced above $2.5 million or so is now taking significantly longer to sell. There just happens to be more properties in the higher price point, there are fewer buyers in that price point, and the buyers that are there tend to be a lot more selective about what they get. However, once you get into the entry-level price points, it just becomes a bidding war free-for-all where buyers are willing to do anything to get a property. And I am just shocked at the competitiveness of the properties in the entry-level price points. These are properties selling significantly over what I would ever realistically pay for the home. These are buyers who are willing to do anything just to find something, and there's just simply not enough inventory on the market to satisfy all the demand.
You know, Graham brings up an excellent point that I wholeheartedly agree with. You get these homes in high price points, and he's talking about $2.5 million or more, which is kind of a bit of a higher price point in Southern California. Maybe in your neighborhood is not quite as high. But he's right. It is tougher to sell those homes. Not everybody can afford them. Your market, your avatar, the demographics of the people who are looking for that home definitely is a smaller fraction for sure. And you're also getting a different kind of buyer. You're getting a pretty educated, savvy buyer who's going to grind you and negotiate towards the end. Whereas what he's talking about, entry-level homes, they appeal to a wider section of the population, therefore there's more demand. They tend to sell very well, I agree. And I found that over the years, depending on that neighborhood, that sweet spot for me could be anywhere from like 700 to like 1.1 million, Maybe for some of you are thinking, wow, that's entry level, but for out here, that's pretty common. So the point is don't just buy a home that you'd like to live in or you think that works. Try to buy homes that appeal to the widest area of the masses as possible.
I know it's inevitable when I say this, there are going to be people telling me to wait because there's about to be a massive market correction and I should just hold on to my money and not invest it at all. And I would be a liar if I said that volatile market conditions were not on my mind or that I'm just uncertain about the short-term direction of all markets in general. But I also realize that markets can oftentimes be completely irrational and no one can predict the future, so it doesn't make any sense to sit on the sidelines and wait and play defense just out of fear. Here are my thoughts. I have absolutely no idea what's going to be happening happening in the short term. I don't have a single clue. Like last year, I made the prediction that interest rates were going to be rising until they hit about 5%, until the Fed decided a few months after that I was going to be wrong and they were going to lower interest rates. That caused housing prices to continue their climb upwards and really encouraged a lot more people to start to buy. And for me, during that time, I refinanced 2 of my mortgages, and from that, I ended up saving a few $100s a month in cash flow just because interest rates went down, so that was a huge win for me. But now, speaking of a bubble or a market correction, in terms of people who are actually buying real estate right now, all of them tend to be extremely qualified. Banks just aren't handing out loans to anybody who asks like they were in 2006 and 2007.
He's right. So many people are worried about doom and gloom and this big market crash that we had in 2011, you know. But what people don't realize is there was a lot of irresponsible lending going on in those days, and I know I was involved. I was in the industry, I saw it. I saw people were getting loans all day, all night without verifying their income, you know. So everybody keeps talking about this correction and things like that. Listen, I don't worry about that. It's very simple. You take a property in a market, and you do what's called kind of like a SWOT analysis: strengths, weaknesses, opportunities, threats, right? And the bottom line is whatever you identify as a weakness or a threat, right? You know, the home's located next to an apartment complex, or it's located next to Dow Chemical, or you're worried about the market, interest rates are going up or whatever. Always remember this, especially like in our neck of the woods. Now, if you're some little rural area that's got, you know, very small population, well, that's different. But in bigger areas, especially like we're in Southern California, there's always going to be demand for housing, okay? People are always going to want to have a home. They're always going to want to be the owner of their property. They're always going to want to have a roof over their heads. And because population is growing, there's always going to be a whole new level, a whole new class every year of new buyers, either people, first-time buyers or existing buyers that are upgrading, had kids, whatever, and they need a bigger home, or even downgrading. You know, the empty nesters, and it's time to downgrade. So the point is, there's always going to be demand. And what does it mean is that if there's adverse factors, sure, demand's affected, but always remember this: everything is a function of price. Even the crappiest piece of shit junker out there, it'll sell, right? It'll sell as long as you offer it for the right price. I can't imagine a car out there that we wouldn't buy for $100, right? Well, real estate is no different. So don't sit on the sideline and don't be all worried and be negative, Nelly, oh no, this is gonna happen. Just say to yourself, you know what? I'm gonna buy this home, but I'm gonna add a little bit extra cushion in case something goes wrong because I have these concerns. And that's what it comes down to. Even in the crappiest market, homes sell. They're still gonna sell. They're just not gonna sell as high as what you expected. So you're not out of the game during those days. It just means that you gotta be smarter and you gotta buy them at a better price.
My intention is to buy a property that I'm going to be keeping for the rest of my life, because ideally I want to buy a property, pay it off over 30 years, live off the cash flow, give it off to my future kids one day, and hope that they don't spend that on drugs.
So he talks about he wants to buy a property and he wants to keep it for 30 years. That's his intention, pay it off over 30 years and get the cash flow, which is not bad. That strategy can work for you. I can tell you that when I was his age, I decided that I wanted things faster. I wasn't always the patient person. So my thing was, it's a very basic principle, and that is you can't eat equity, okay? Equity makes you sleep good at night, and it's a nice feeling, right? But you can't eat it. And what does that mean? It doesn't put food on the table. It doesn't work for you. I'm into making assets work for me, okay? So, for example, I don't know if I would recommend for you to buy a home and pay it off 30 years. Maybe your principal residence or whatever, but I would recommend do a lot of investments, do a lot of deals, and if you have some equity, translate that equity, buy a few more properties. You know, what you're gonna find over time, your greatest wealth accumulator, right? It's not gonna be the freaking cash flow. You heard him mention earlier, he just refinanced and he's getting extra $200 a month now because of that. Well, we all know that's a dinner. That's you and your girlfriend, you and your wife. That's a dinner if you're eating the right way, okay? So my point is, you're not gonna get real far in life with $200. But if you own multiple properties, the greatest growth is gonna come from is appreciation. Take a look at what homes cost in the 50s, the 60s, 70s. Do it every decade, you know? And you're gonna see that there's been a continuous trend of an increase in value, okay? And that's where the real money comes in. So you don't need to have a ton of equity for your home to go up in value. It's got nothing to do with it, right? It goes up in value because there's other factors, right? Values of a home is that acronym DUST: demand, utility, scarcity, transferability, right? There's other factors that affect it. So my point is I like to take some money out of the homes and buy some few homes. Now that I'm getting older, I've been doing this 24 years, yes, now I'm interested in starting to pay down and pay off some of my stuff, and I've done that. I've paid off, I don't know, at least a dozen of the homes. I've already paid them off, and there's still more that I haven't paid off. But the point is that because I'm at a level now where I say it's very humbly, I'm very comfortable, I'm very financially fit, right? So it's okay for me right now. I like a little bit of stability. But for you guys out there that are growing and trying to grow your empire, you know, I think your empire will go through two stages: wealth accumulation and wealth maintenance. And if you're in the wealth accumulation where you're not happy where you are, you want more, then I don't suggest that strategy. I say that if you have some equity, use it. Make that money work for you. Take that 50 grand, take that 100 grand and triple it. And triple it so that 2 or 3 years later, now you own 4 or 5 homes. And these homes are going up every year.
Let's just say there's a property listed for $1.7 million, but it needs a lot of work. Maybe they didn't market it correctly, and maybe they just need to sell it immediately to move on to something else. Those are the types of opportunities that I am interested in, because maybe I might be able to buy it for $1,350,000, offer them a quick close, and then that way if the market goes down in price 10 to 15%, well, you know, I bought it at such a good deal where even if the market does go down, then I'm not really losing any money.
Right here, he gives an example of a home that's listed for $1.7 million, and he's saying that it's worth $1.6 million. Okay, so the seller's asking for too much. And he'd say he'd like to buy it for $1.35 million. So essentially, if he was able to buy this home, he would get a $250,000 equity split or whatever, right? So let's see, let me do the quick math. See, 250, so that's about 15%. Yeah, so a matter of fact, it says it here, if market goes down. So what he's saying is he wants 15% discount on these homes. And that way, if the home goes down, what he's saying, 15%, he's okay. He's got enough equity that he'll survive that. Okay, listen, this is what I mean about the MLS. In life, we do what we can. The Jamaicans created a bobsled team. How do they do that, right? Living in a tropical area. But my point is, we do what we can. That's not a common thing. Now, Graham, you can tell, is a sharp guy, but he has a different perspective. You see, I grew up in the meat of investors, of guys that were hustling, that were shaking and baking to do deals. So we have a different way of thinking about things. Our way is this: I don't really buy homes at a 15% discount. I just don't. And I can't remember the last time I did. And if I ever did, if somebody says, oh, Joe, remember that home 8, 9 years ago, 11 years ago? Okay, it may just be because that home had something unique and special about it, that like it was on the water or something like that. And my wife just loved it, loved it, loved it, loved it. And it was so unique that we couldn't get a big discount. But that is so rare that I can't even remember it happening. I like things with a lot more meat on them, even though I'm a vegetarian, but I still like that meaty flavor, that meat sensation, right? I would never advise you guys to buy something, no disrespect, Graham, at a 15% discount. The split, the numbers just aren't there, okay? And why? Because it's real simple. There's other deals. There usually are other deals. And if you're not finding them, it's not because they don't exist, it's because your strategy is flawed. Like I said, you can go to tax sales, you can buy properties in foreclosure, you can buy probates, you can get abandoned properties, vacant homes, non-owner occupied, absentees. There's so many designations that over time I'm going to teach you guys. And the point is that you can buy homes that have a much better spread, right? And if you buy homes, and follow what I'm saying with these spreads, now if you keep it, you're going to be doing really well, but also too, you get a good chunk of equity. What's the moral to the story? Maybe the multiple listing service is not your best source, and it could be your best source under one circumstance. If you're watching my videos, you'll know this. If you've got the inside scoop, if you have like an agent who knows what's going on and says, hey, Joe, I got this seller who's going to dump this home at a ridiculously good price. I'm the first phone call, and the agent's like, do you want it? I'm like, yes. And they right away in the multiple listing service call it pending, and that's it. Nobody else can get it. And those are far and few in between, okay? But other than that, when you're in a public domain where everybody and their mom can see that, then it's hard to find good deals there, okay? So like I said, it might work for him, but I would not advise buy properties in the 15% equity, because it really isn't. By the time you sell it, you pay closing costs, real estate commissions, carrying costs, holding costs, things like that. You really haven't done that well, okay? So there's something to be said that if you're at the dance that night and maybe you got your sights set big, you don't need to dance with the first person that approaches you. You got options. You just got to be patient, keep your eyes open, and there's better options for you, okay? But you got to like dancing. So listen, hopefully you guys enjoyed it. Hopefully I didn't bore you guys, and I look forward to seeing you guys on my next videos. And please, if you think I spoke from the heart and spoke honestly and I'm trying to show you guys something, please like the video and please subscribe, okay? Thank you guys very much.